I have upgraded NextGen to a 4. I had it as a 5. It is, in fact, the best undeveloped uranium deposit on the planet.
Back to Metals and Miners. I'm its founder and its host, Gary Bohm. Today we have a fantastic discussion lined up. We're fortunate to have with us Rick Rule. Rick is the president and CEO of Rule Investment Media and Battle Bank. He was the founder of Sprott U.S. Holdings and held the CEO position for 10 years. Rick, thanks for returning to Metals and Miners and for joining us today.
Gary, certainly a pleasure. I apologize for my studio. I'm on remote at a bed and breakfast in California, helping my wife recover from surgery. So it's not the studio that you're used to recording me from at home, but we'll do our best.
Well, I certainly hope that she heals quickly. And I, too, am a little under the weather. I might cough or sneeze, so I apologize for that. Rick, you host an annual symposium for metals and mining investors down in Boca Raton, Florida. Last year's conference was fantastic. I was there, and I really enjoyed it. The location, the conference goers, the speakers, the sponsors. It was exciting. It was informative. It was extremely well done. And for those watching, it really is a must-attend event. This year, you're having it down there again, same place, week of July 7th. Would you share with everyone a bit about the Rule Symposium for 2025?
Delighted to. First of all, this is, I'm told, our 30th year in operation. So we've stood the test of time. How do we do that? Well, to begin with, we have great macro speakers, big picture thinkers, but they're not journalists. This year we have David Stockman, who ran the Office of Management and Budget under the first Reagan administration. Let's say that he founded the first Department of Government Efficiency. And he wrote a book called The Triumph of Politics, talking about the derailing of the Reagan Revolution in 1980. He's written a recent book called How to Actually Cut $2 trillion from the federal budget. There is no more pressing economic or financial piece of news today than debt, deficits, and the U.S. budget. Who better than a guy from the belly of the beast who tried to reform it before? Moving on to talk about the Fed. We have Daniela DiMartino Booth talking about the Fed because she was part of the Fed. She was a researcher for the Fed. We have Nomi Prinz talking about the structure of Wall Street because she was a partner at Goldman Sachs. We have Jim Rickards talking about leverage in the financial structure. Who better? He was general counsel of long-term capital management, whose failure almost brought down Wall Street. Yeah. Our theme, Gary, is that macro comes from the belly of the beast. We don't have journalists talking about macro. We have players talking about the institutions because they are from the institutions. Once we've given you a macro viewpoint that is very unlike the macro viewpoint that you would get from CNBC or Fox or MSNBC, we bring you analysts around precious metals and natural resources, not junior brokerage firm flunkies who have failed in pot stocks or failed in crypto or failed in consumer durables, but rather portfolio managers and investors who've managed billions of dollars in natural resource investments for 2 or 3 or 4 decades. Moving on from that, of course, we have the living legends. Entrepreneurs who built multi-billion-dollar mining companies from scratch, talking about how the process has made them better investors and how you can be a better investor too, teaching you how to find the $25 million market cap with a great entrepreneur that could become a $5 or $6 billion market cap. Absolutely invaluable information. Further than that, every single exhibitor at our conference is content too. At every other conference I know of, the qualification to be an exhibitor is simply a check that cashes. At our conference, every public company exhibitor is owned in the accounts of the conference sponsors. Now, there's no guarantee, Gary, because I own a stock, that the stock goes up, but there is a guarantee that I've vetted that company if I've written them a check and I'm a shareholder. What all of this allows me to do is say to anybody who attends the Natural Resources Investment Conference that you have a full, solid gold money-back guarantee. If you think for any reason attending either live in Boca Raton, which I would prefer, or attending via live stream in the comfort and convenience of your own home. If you aren't 100% satisfied with the value I deliver you, simply email me, no questions asked, you get your money's worth. You got to do two things for me in return. The first is if you're a tourist, if you're somebody who reads the newspaper for the funnies in the crossword puzzle, don't come. We're going to give you 50 hours of complex, dense programming in 4 days. Now, we're going to give you access to the full conference recordings for a year, whether you attend via live or live stream. That's the good news. The bad news is you're going to have to play them because we're going to give you more information in 50 hours than you can absorb in 50 hours.
That's very true.
But the guarantee continues. This is the finest natural resource investment event in the world. The consequence of that is that I am able to say to you with an absolutely clear conscience, absolute unconditional money-back guarantee. The financial risk is all mine. If you're a serious natural resources or precious metals investor, or in fact, if you are merely somebody who is concerned about the impact of our nation's debt and deficit, the structure of Wall Street, and the over-leveraged nature of all aspects of U.S. society, this will absolutely be worth your while.
Absolutely. I appreciate that broad overview there. I'm going to put a link in the description for everybody to be able to click through, learn more, and purchase their tickets if they desire. All right, Rick, the Trump administration is set to announce new tariffs at 4 p.m. today with details still being finalized. President Trump has been calling this Liberation Day. With tariffs set to take immediate effect, how might businesses and markets react to the uncertainty surrounding the final structure of these trade policies? And given the international responses we've seen so far and the potential for retaliation, how could this impact global trade relationships and the strength of the dollar moving forward?
Well, Gary, first of all, let's be straightforward here. Tariffs are taxes, and taxes suck. I don't want to be liberated by taxes. I want to be liberated from taxes. The idea that he imposes a tax on Chinese merchandise or Canadian merchandise or Mexican merchandise, and the Chinese or the Canadians or the Mexicans pay the bill is laughable. It's about that wall. It's like that wall he was going to build with Mexico's money. Now, I don't want people to think that, as an example, I preferred Biden to Trump. I have no use for either of them. I prefer Gary. But people need to understand that behind the nationalistic, jingoistic nature of these things, tariffs are taxes. Taxes are bad. Division of labor, internationalism, responsible internationalism, truly free trade, not managed trade, is good. And when I talk about free trade, I'm not talking about NAFTA. NAFTA was a 3,600-page document. If you and I wanted to have a free trade agreement, it would be one paragraph saying that there would be no legal obstacle to the free purchase and sale of goods between our two countries. That's it, right? We both sign it, it's done. But these tariffs are in the same spirit that NAFTA was in. It's a framework for punishing the administration's enemies and helping the administration's friends. Remember that politics, whether Democrat or Republican, are, in the words of H.L. Mencken, always and everywhere advanced auctions of stolen property. That's the nature of it.
All right. So, Rick, you've been a credit analyst, as you've talked about, for many decades. I have a credit-based question for you. Given the widespread distortion of credit data post-pandemic, including inflated scores, hidden delinquencies, and government-driven reporting manipulations, how do you anticipate the true credit risk of households and corporations will unfold in 2025? Specifically, could the convergence of resurfacing student loan defaults, rising mortgage delinquencies, and tightening credit conditions, could it trigger a systemic crisis, or do you think the central banks are going to find new ways to further the delay of reckoning?
Gary, that's the single scariest question I get asked. You know, I'm not a gloom and doomer. We're going to come out of this over time, okay. But the truth is that, first of all, the systematic management of interest rates lower, artificially low interest rates. For an old fat guy like me, they're a great thing. If you have access to credit, subsidized credit is good for you. But if you're a saver, it's bad for you. an old fat guy like me who has access to credit and knowledge of how to use it, subsidized credit is a wonderful thing, but it's a horrible, horrible, horrible thing for society. And the misreporting that you describe is, I think, worse than even you realize. At its most simplistic lesson, the CPI should be called the CP lie.
Right.
If you believe the CPI, it suggests that the deterioration of your purchasing power is cruising along at 2.6%. What a joke. Compile a list of goods and services that you consume, look at their prices in 2020, and look at their prices now. Rent or mortgage payments, gasoline, groceries, healthcare, health insurance. I believe that the deterioration of the purchasing power of American savings and salaries is declining at between 7.5% and 8% a year, not 2.6. I went through this once before in my life, in the late part of the decade of the 60s. That resulted in the decade of the 70s. Now, the single scariest thing to me, Gary, and by the way, I'm not forecasting a sort of a 2008 style event, but the black swan that really scares me is junk corporate debt and the fondness for fairly naive ma and pa investors in the United States to chase yield. In particular, there are trillions of dollars of high yield ETFs, which are extremely liquid at the ETF level. Hundreds of millions of dollars of these things trade every day on the stock exchange. But the assets that they own, the junk bonds, the over-the-counter bonds that make up the portfolios of these ETFs are highly illiquid. Mm-hmm. If ma's and pa's across America get concerned about credit quality, and I think they should be concerned about credit quality, and they begin to sell the ETFs, which are highly liquid, the manager has to sell the underlying assets, which are illiquid, to fund the liquidations. In the 1970s, Gary, we had a saying around junk bonds, illiquid junk bonds. We called them owl bonds. An owl bond is when you call your broker and say, sell the bond. Your broker says, to-hoo, to-hoo. If there's one thing out there that scares me more than anything else, with the exception of nuclear war, it is the proliferation of junk bond ETFs and the ownership of those ETFs by naive investors who know absolutely nothing about the asset class that they're invested in. So an odd thank you for the question.
Well, I appreciate you sharing that. And I also appreciate the disclaimer that you're not a gloom and doomer. So, Rick, President Trump, he recently signed an executive order aimed at bolstering U.S. critical mineral supply chains. The order seeks to reduce U.S. dependence on foreign-controlled minerals, particularly China's dominance in rare earth processing, by prioritizing domestic production and streamlining permitting processes. While the U.S. has significant reserves, that's true, the midstream processing infrastructure, it's really lacking, making this executive order a crucial step towards reshoring the capabilities. How quickly can the U.S. realistically scale up its critical minerals midstream processing capacity, and what challenges stand in the way of achieving supply chain independence from China?
3 or 4 problems. The first is resource acquisition. While it's true that the United States has some resources, the resources that we have in terms of tonnage and grade are not competitive on a global scale with resources that exist in other countries. So in addition to having to subsidize the U.S. supply chain, we have to secure access to foreign supply. This will take a long time. There's little competitors against us. People like Korea, Japan, China, the European Union. We don't act in a vacuum. The second thing is, should the industry want Mr. Trump's help? The truth is, as a natural resource investor for 3 decades or 4 decades, I've been reviled, hated. 5 years ago, people like me who were investors in uranium were regarded as profiteers on Hiroshima, Nagasaki, and 3 Mile Island. Now these morons propose to subsidize us. I felt much cleaner when I was reviled. I would prefer that the administration merely got out of my way. The second question is, assuming that you have a way clear at the top, which is to say Mr. Trump, he has to deal with state and local regulations. Remember that regulation in the United States is tripart. And I'll give you one example of that problem. One of the best undeveloped copper deposits in the world is the Resolution deposit in central Arizona, beautifully located amongst a whole bunch of copper mines. It's a great place to have a copper mine. There's roads, there's rail, there's power, there's water, there's towns with gas stations and 7-Elevens, and those towns are populated with copper miners. Couldn't get better than this. Deposits over 1 million tons of 1.5% copper. To put that in reference, the global average mine grade worldwide is 0.5%, and this is 1.5%. And this deposit has been stuck in permitting for 26 years. So you ask how long it might take. I'm 72 years of age. Most of my remaining lifetime is the answer. And by the way, I'm a very healthy 72-year-old.
Incredible. All right. There's accelerating demand for critical metals and minerals driven by the energy transition, AI data centers, and reindustrialization, coupled with years of underinvestment in supply. Is it your opinion that resource bottlenecks will be the defining investment theme of the next decade, specifically with the likely top in the Mag 7 tech trade? Are we now at an inflection point where capital can start to rotate in mass from overvalued growth stocks into undervalued resource producers?
I'm not going to agree with the whole statement because I don't know enough about growth stocks to know how to value them. I know a lot about natural resource stocks, though. And my suspicion is that you will see increasing capital investment in all aspects of natural resources. I suspect for most of your listeners in the near term, gold is a better place to be. But over the next 5 years, this systemic underinvestment in the materials that are required for the continued material well-being of humankind will do very well. We've underinvested even in the big ones like copper for 30 years.
Yeah.
We have impending supply shortages no matter what we do. In other materials, the ignored materials, as an example, rare earths, which aren't rare, the potential bottlenecks are much, much, much worse. I think it's incumbent on your listeners, most of whom are probably American, that they think about this context in a global basis, that they forget a little bit of their political bias, and that they look for the best deposits on the globe. Because your biggest risks aren't political, those are risks. Your biggest risks are technical. A lousy deposit remains a lousy deposit, whether or not you have a favorable administration next to it. A good deposit remains a good deposit. It is better, you are better off having a deposit that a government wants to steal than having a deposit that's not worth stealing.
Those are all very... Today's video is sponsored by Monetary Metals. What if your gold could grow over time so that you're not just preserving, but growing your wealth in an asset that can't get inflated away by more money printing? Monetary Metals lets you do just that. You could earn 3% on gold, paid in gold, in their secure gold leasing program. And if you're an accredited investor, you can earn even higher yields in their bond offerings. Previous bond offerings have paid 6%, 12%, and even high as 19%, all in ounces of physical gold and silver. The interest you earn is paid in ounces of physical gold or silver, which you get in addition to any price appreciation from gold and silver during the year. The question is this: why earn in dollars when you could earn in gold? Join thousands of investors earning interest in physical gold and silver every single month with Monetary Metals. So visit monetary-metals.com/BOOM to learn more. Good points. All right. So Rick, given the structural shift towards capital discipline favoring buybacks, dividends, and balance sheet strength over new projects in gold mining specifically, how long can producers maintain this restrained approach before competitive pressures or reserve depletion force a return to aggressive exploration, expansion, M&A, et cetera?
Until a year ago, we're in the M&A cycle right now. There isn't a month that goes by that I don't get a call from a major or intermediate gold mining company saying, who should I be looking at? What opportunity should I be entertaining? Some of them will admit to me that their exploration pipeline is empty. That when they call the exploration staff, they're reminded by the financial staff that they laid the explorers off 15 years ago and don't have a department to call. So the circumstance that you're talking about isn't a circumstance for the future. It's a circumstance for the present.
That's wonderful.
We are in the M&A cycle. The recent, by the way, we're in two different types or three different types of M&A cycle. The first is that the share price performance of the best of the gold miners, the biggest and the best, in the last 12 months have been really, truly superb.
Yes.
But there's been a dichotomy. The best of the best have done well and the rest have not done well at all. That means that the Agnico Eagles, people like that, have a very low cost of capital because they have a high share price. And they're in a world where their competitors have a high cost of capital. Capital cost is a durable competitive advantage. If the equities market doesn't begin to do valuation arbitrage, which is to say come down the quality trail, the M&A market will. The low-cost producers will take over the high-cost producers. Similar.
It doesn't seem like it's going to happen by natural selection. So,
well, I mean, look at the takeover of Newcrest by Newmont. That's a classic example of high cost of capital being acquired by low cost of capital. The second thing that's happening is that single asset producers are regarded as riskier than multiple asset producers. So multiple asset producers trade at a higher multiple. The way you fix that is a multiple asset producer takes over a single asset producer, and then arbitrage goes away. And then, of course, there are horizontal mergers. In today's environment, the larger companies have more trading liquidity, higher share prices, and they get more passive and index buying. So recent mergers like the Equinox Caliber merger, the proposed Equinox Caliber merger, are, while not particularly synergistic, certainly ones where we could expect the trading volume, the share price, and the cost of capital to fall as a consequence of the merger. We're in a wonderful circumstance. Mergers add hope and liquidity to the sector if you happen to own the company that's been taken over. But early in the M&A cycle, the mergers are often accretive to the acquirer too. Whatever happens, properly structured mergers lower the cost of capital, spread general and administrative expense over larger asset bases, and give management teams, the new management teams, the ability to make asset allocation decisions across broader asset bases. The question you ask is a great one, and it's an important theme for precious metal and natural resource investors to consider.
How much of a signal is the M&A activity when it increases to the general investing population, especially the institutional investors?
It's a ringing bell. I'm not trying to say that mining companies are great investors, but they're the best investors out there. And if they see that they can acquire assets on Bay Street or Wall Street more cheaply than they can explore and develop them themselves, they are sending a signal to institutional investors who are by their very nature less expert.
So we're right there. That's the stage. That's the stage we're in right now.
Correct.
Wonderful. All right. So the nuclear power investment narrative, it has swung violently from AI-driven euphoria to pessimism in mere months, with only uranium's price action appearing to drive sentiment. Given that the fundamental case, AI, power demand, energy security, decarbonization, given that that fundamental case remains intact, does the extreme sentiment volatility actually create an opportunity for entry right now? And at what point do you expect this disconnect between price-driven sentiment and nuclear's unavoidable demand growth to really resolve violently to the upside?
It's interesting to me that popular sentiment on places like X, and places like that, is often driven by people who 5 years ago couldn't spell uranium. AI, as an example, SMR, these technologies are important facets of uranium demand 7 years from now, or 8 years from now, or 10 years from now. What has mattered has been the pace of Japanese restarts and the refueling cycle in existing nuclear power plants, and to a lesser degree, the pace of new build reactors. This isn't a very exciting theme, so most of the commentators who couldn't spell uranium have ignored it. The pace of Japanese restarts was the most important factor in uranium for the last 4 years. The second most important factor in uranium has been the emergence of the term market over the spot market, where both producers and consumers are freed from the vagary of the spot market and can lock in prices and volumes for 10 years, 15 years, or 20 years at a time. For junior developers, this is particularly important because they have the ability, for the first time in recorded history, of using the balance sheets of the investment grade counterparties in term contracts to secure production financing to build their mines. When you read the social media comments by the pundits who couldn't spell uranium 5 years ago, you will notice a decided lack of discussion around the most important facets of the uranium business. One thing that's happened very recently is that although the announced pace of Japanese restarts has been very rapid, the actual pace of Japanese restarts is sold. What that has meant is that as many as 15 million pounds of uranium that many analysts, myself included, had believed would change from that column heading held for sale, which is to say redundant, to held for fuel. What's happened is that the Japanese nuclear power industry knows they're going to need the uranium 3 years from now or 4 years from now, but they know they're not going to need it in 2025 or 2026. So that uranium is being leased in the market, not sold, leased. The utility will allow somebody else to use that uranium with a credit grade counterparty that agrees to pay them back in uranium, not in cash, 3 years from now, 4 years from now, 5 years from now, at a 3.5% interest rate. So the spot market has gone from woefully undersupplied to being reasonably supplied. That's it. Now, for me personally, given that the underlying circumstance in the uranium market hasn't changed at all, the fact that the share prices have fallen by an average of 50% and in some cases 75% is an unalloyed good. This is a wonderful thing. Imagine that you were, with summer coming, looking for, I don't know, beach clothes or something like that, some goods that you would use in the summer. And imagine that as a consequence of a temporary overstock, you found a place where those goods that you wanted to buy were on sale for 50% off. Would you be distraught or would you be happy? People often make rational financial decisions around shopping for physical goods, but those same people often make amazingly stupid decisions with regards to financial goods.
So it sounds to me like what you're saying, and maybe there's more of a caveat here that I'm missing, but it sounds to me like where we thought this, imbalance between supply and demand was going to hit 23 to 25 ish is now pushed out through some creative leasing and whatnot. It's pushed out a few years.
But not very far. I mean, the spot market in uranium is becoming increasingly irrelevant, first of all. Most days, the trading volume of the Sprott Physical Uranium Trust on a dollar volume basis is greater than the trading volume of the spot market. It could be said that the Sprott market is the spot market.
Right.
But it's an increasing irrelevancy because what matters is the term market. And when you see spot at 62, you very often see term at 75 with escalators. That's where the action's taking place. But it's opaque. The average investor can't see it. The average investor has to look at Cameco's quarterly report and work backwards in terms of the realized price per pound. That's much more work than the average investor could do. The average investor would rather go on X and get his or her opinion formed by somebody who 5 or 6 years ago couldn't spell uranium.
How true. Excuse me. Okay, so Rick, success leaves clues, and you've repeatedly emphasized not only your deep understanding of the mining space, but knowing who you're investing against as key reasons for your success. Drawing from your decades of experience, what do you consider the key principles or strategies that have enabled you to consistently succeed in the complex and volatile sector? And how does knowing who you're investing against help you to win?
Well, the first is you have to do the work. I'm competing against many people who buy the newspaper for the funnies and the crosswords. And I buy for the editorial on the front page. You have to do the work. I've graded tens of thousands of portfolios in 25 years, and I've learned a lot about how investors invest as a consequence of that. And I've noticed a couple common flaws. First of all, most people are anti-contrarian. They want to buy uranium stocks after they've doubled, not after they've fallen by half. This is fairly simple arithmetic, but you have to do the work so that you have some sense of value. The second thing is that most investors and most speculators are extraordinarily impatient. There was a study I saw done by Fidelity Management, the great big mutual fund group, and they have millions of investors in their database. And they diced and sliced those investors by things like ethnicity, age, gender, income, credit scores. And Gary, do you know who the best subclass of investors was at Fidelity?
The dead.
Dead people. That's exactly right. The people who didn't trade, the estates who didn't who didn't buy or sell, outperformed every other class of investors. Many investors that I talk to, many speculators that I talk to, have absolutely ironclad 5-year, 6-year, or 7-year narratives, but they have trauma holding stock over a long weekend.
Right.
If you are investing in a 5-year narrative and you have a 3-month strategy, of course you're going to lose money. Of course you're going to lose money.
Well,
Remember, too many people view the market as a subject itself or a product. It's not. It's a facility to buy and sell fractional ownership in businesses. You have to do the work that allows you to have some confidence in the value of a company before you care too much about the price. People pay slavish attention to the fact that a stock has gone from $1 or $2. I ask them what they think the stock is worth, and they say $2. And I say, no, wrong. That's what it's selling for. A much more valid question is, what is it worth? If you have a sense of value and the stock goes down substantially below what you think it's worth, that should be a buy. If you have a sense of value and the stock is selling for substantially more than you think it's worth, that should be a sell. For most people, because they have no sense of value, they get their sense of appropriate pricing from the market. The same people, as I say, whose opinion around the uranium market is formed by people on X who 5 years ago couldn't spell uranium.
Rick, let's take the next few minutes to rank a few mining companies from the gold, silver, and uranium spaces for the investors who are watching. You can give them a score of 1 to 10, with 10 being the most investable, 1 being the least. You could
Other way around, please. Other way around.
Yeah, fine. Other way around. Yeah, that's fine. Come at it from whatever perspective that you want, educationally or whatnot. Just offer a brief perspective on why you rank them the way that you do. And let's start with the gold miners. Rick, let's begin with IM Gold Corp. They have significant ownership stakes by BlackRock, Vanguard, and their management team. What's your ranking for IM Gold and your perspective on your ranking?
I have IM Gold as a 6. I am looking forward to upgrading it as a 5 as more production results come in from Cote Lake. IM Gold has had a historical problem with reinvestment of capital, which is to say they've made horrible capital allocation decisions for 20 years, and shareholders paid the price. They've put most of their eggs in one basket. It appears to be a very good basket, but I'm not a trusting person. I want to see the results come. If the results come, as I suspect they might, either the price of IM Gold goes up or somebody else takes them over. But until I know that my suspicions are matched by production efficiency and all-in sustaining costs, I'm not willing to upgrade them. Understand that these rankings are all snapshots in time. The next quarterly news release could confirm my hopes and suspicions, and I could upgrade it. So understand that the half value of these, the half-life of these rankings occurs this week.
That was a good play on uranium. I appreciate the disclaimer, though. All right, the next one is Allied Gold. They're Africa's fastest growing gold producer. What's your ranking and perspective on your ranking?
I have Allied as a 5, and I'm looking forward to upgrading it to a 4. Note of conflict of interest, I own Allied, and I have since before it was a public company. I'm very fond of the assets, and I watch the management team's financial acumen at Yamana. This is a highly speculative stock, developing several projects simultaneously and doing so in fairly immature political jurisdictions where lots could change. This is not for the faint of heart. I am not among the faint of heart.
Now, that management team, when they were over at Yamana, they did something quite extraordinary, didn't they?
Well, I'm not sure that this management team did. They were probably the successors to Moroney and the original team. Okay. But the truth is, they are great financial operatives in the gold mining industry. They have done a great job of merger and acquisition, and I would say a reasonable job of mine development and mine production. That said, I think that they are in a geological domain, which is to say West Africa,
Hmm.
that's particularly perspective for what they're trying to do. What they're trying to do is recreate the success of Randgold, which became Barrick, and Endeavor, which were two absolutely spectacular successes in my past.
Wonderful. All right, let's move over to silver. Rick, Dolly Varden Silver, it's got a pretty sizable investment from Eric Sprott. What's your ranking on Dolly Varden and your perspective on that ranking?
The stock has performed too well, and so it has fallen from a 4 to a 5 to a 6. These guys have done a wonderful job, but the market has rewarded them too well. If they can connect the dots between the Valley Zone and Homestake Ridge, and perhaps connect some dots between them and their new acquisition, the Porphyry acquisition, these guys could go absolutely crazy. If, for me, isn't a very good investment criterion. I prefer questions where the answer begins with when, not if. I own Dolly Varden because I like the assets. But people should note that I own Dolly Varden because I've sold enough that I've paid for all the stock that I still have from the proceeds of prior stock sales, which is to say I've achieved what I call the point of no concern as opposed to the point of no return.
That's a good place to be. All right. Adriatic Metals, it's strategically located in Europe. What's your ranking and your perspective on your ranking?
I have Adriatic as a 4. I think production difficulties and political challenges in Bosnia are overdone. I love the exploration potential here. I believe this to be a classic volcanogenic massive sulfide discovery. Those discoveries usually occur in bunches. So I think the exploration upside is good. I like the fact that quarter to quarter, too, they are getting better at producing the deposit, both in terms of processing it through the mill, but also in terms of integrating the underground mining operations with the processing operations. At commodity prices that existed a year ago, this was a zinc and copper predominant deposit. As the ore body changes and as commodity prices change, this is becoming a silver dominant deposit. And I think as the mine matures, this will come to be regarded as a silver company and likely be re-rated at the same time that their operational performance increases.
Interesting. Okay. So let's rank a few uranium miners now, Rick. Uranium Energy Corp, it's another Sprott Asset Management holding. What's your ranking and your perspective?
I own UEC, first of all, and have for many, many years. I have a high regard for Amir Adnani. I had downgraded them to a 6 because the stock had done so well. As they did a good job maturing the company and developing the assets, the share price fell. And I have upgraded it from a 6 to a 4, from a 6 to a 5, and from a 5 to a 4. As the share price fell in half, while the company's fortunes were improving, obviously, given that my rankings are really a juxtaposition between the price of something and what I consider its value to be, that share price decline has been very, very, very critical in my upgrade of the company's prospects.
And finally, NextGen Energy, it's estimated to yield approximately 30 million pounds of uranium near the end of the decade. What's your ranking and your perspective for them?
I have upgraded NextGen to a 4. I had it as a 5. It is, in fact, the best undeveloped uranium deposit on the planet. Has been for a long time. The general and administrative expenses with the company are out of control. Let's get that stated. Once you get over your outrage at the G&A, you learn that the management team has done some things fairly well. The engineering studies have been good. The floral and fauna studies have been good. The water studies have been good. The relationships with the Métis and First Nations relationships have been good. In other words, an awful lot of de-risking has gone on at this deposit underneath the scenes. Yes, the fact that they want naming rights to a stadium or that they sponsor Formula One racing is the height of idiocy. You're not going to find uranium investors at a Formula One. Truly insane stuff. A uranium investor would be very hard put not wanting to own, depending on price, the finest undeveloped uranium deposit on the planet, which this is. The fact that the share price decline has been so precipitous in the last 6 months has allowed me to, while I hold my nose at the G&A, need to own the company.
Okay, interesting. Okay, so I want to welcome everybody to this fantastic interview with Rick Rule, founder of the Rule Symposium and Rule Investment Media. It's been a wonderful discussion so far. Before we wrap up and we have our final set of questions for Rick, I want to direct everyone interested in the metals and mining sector to dive into our Substack at metalsandminers.substack.com. Join our quickly growing community and receive a free report titled "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio. Consider upgrading for access to premium content, but even without premium, there's plenty of free content daily. So visit metalsandminers.substack.com to join us and explore. Thanks again for watching this interview. Now, I'm positive that you've enjoyed the conversation with Rick as much as I have. Please let him know. Hit the like and subscribe button and leave a comment below the video. All right, Rick, let's finish off the discussion with what we spoke about earlier before we started taping, and that's what I call a lightning round. I'm going to ask you, and disclaimer, this also has a half-life. But I'm going to ask you to rank a few assets as a buy or a sell by giving it a score of 1 to 100. 100 is extreme buy, 1 is extreme sell. Just give 1 or 2 sentences. We're going to flow through it pretty quick, okay?
Let's go.
All right. Gold on a scale of 1 to 100.
For most people, I would have to say 85 or 90. Extraordinarily attractive given the challenges that you face as a sovereign investor in fiat-denominated instruments. I wish I didn't have to say that. Gold does well, other parts of your portfolio do poorly. So pray I'm wrong.
Yeah, but it's true. Gold miners.
I would have to say for most people 75. You have to own gold. You don't have to own gold miners. To own gold, you don't have to do any work. To own gold miners, you have to do a lot of work. If you aren't willing to do the work, don't own the miners.
Silver, physical.
Physical silver, I would have it a 75. You don't have to own it. Silver is for speculators. Gold is for savers. Most people, everybody needs to save. Not everybody needs to speculate. At some point in time in a bull market, precious metals bull market, leadership changes from gold to silver, and then silver outperforms gold. But nobody needs to speculate. Nobody needs to own silver. You own gold out of fear. You own silver out of greed. I own both.
Silver miners.
Silver miners, I would have to say 60 or 65. This is a really speculative asset class. People like it because it's the most volatile asset class in the space, to the upside and to the downside. If you're going to own the silver miners, I own a lot of them, be prepared to do the work. Understand to the upside that the market capitalization of the silver mining space is so small that if, as and when the generalist investor comes down into the space, as Doug Casey says, the result is like trying to siphon Hoover Dam through a garden hose.
What a visual. Copper.
I think copper, if you have a 5-year horizon, is a must own. We've underinvested in copper for 30 years, but it's the essential ingredient, along with oil, in the material well-being of humankind.
So what number would you put on that?
I would say for most people, I'd have to say 60 or 65, because although most people have 5-year narratives, they have 3-month tactics.
Right.
So if you aren't prepared to stay the trade, copper is going to expose you to a lot of volatility. Don't do it. If there's some commonality between your strategy and your tactics, absolutely do it.
Uranium, the physical, the metal.
I would say 60, 65. The uranium price doesn't have to go up for a couple of years. The incentive price offered up by term contracts at 75 with escalators is plenty. So you don't need to own physical uranium. I own it because I think the price is going higher anyway. But for most people, I would have physical uranium represented by Sprott physical uranium at a 60.
Okay. And uranium miners.
Oh, uranium miners higher. Again, you have to do the work. But uranium miners are cheap relative to the metal. And by the way, when I say the uranium miners, I'm not talking about the 80 pretenders. I'm talking about the 10 or 12 companies that have developable assets at these uranium prices. I would have to say for people who are willing to do the work, that's a 75. And Cameco, the biggest and the best, I would say that's 80 or 85.
Okay. Excuse me. Oil.
Oil, 80. Again, there has to be some juxtaposition between the time required for the narrative to play out, and people's tactics. The big thinkers of the world would have you believe that peak oil demand occurs in 2030, which is silly. What would they use to fly all their jets to Davos to tell you to drive less?
Right.
Oil is cheap. Oil stocks are cheap. They are generating enough cash to make sustaining capital investments while increasing dividends and doing shared buybacks. And it's widely hated. I can't think of a better circumstance than that.
The NASDAQ.
I don't know enough about the NASDAQ to comment.
Okay.
I know a lot about conventional financial services, banking, insurance, and I know a lot about natural resources. And I don't know a damn thing about most aspects of the economy, so I don't dabble in it.
Okay. What about the S&P? Same, or do you have
Same comment. I have no idea.
Okay. Short-term treasuries.
Short-term treasuries you have to own. You're going to lose money, but you have to own them. You have to maintain liquidity. The short-term treasuries pay you what, 4.2, 4.3, something like that, in a circumstance where the purchasing power of your savings is declining by 7.5. But the negative yield that you suffer is an option premium on having access to the cash and the courage to do something in the circumstance of a liquidity squeeze. You have to have them, and you will lose money.
Put a number on it, 1 to 100.
100.
100. All right. Long-term treasuries.
3 on a scale of 1 to 100.
You're not alone, by the way.
Certificate of guaranteed confiscation, in the words of Franz Pick, I think it was. The natural interest rate is substantially above the natural rate of inflation. If the natural rate of inflation is 7.5 or 8, the riskless rate of return should be 10 or 11. The long-term bond selling at 4.6 feels to me 65 or 70% overpriced.
Fair point. All right. Now on a scale of 1 to 10, each representing a percentage, like 1%, 2%, where do you see inflation ending 2025?
Whose measurement of inflation?
Well, let's stick with what they're calling inflation. So say
that's manipulated. I don't know. I mean, the CPI is the CPI.
Yeah.
That gauge doesn't include tax. I mean, it's a stupid.
So they have it, what, at about 3% right now, somewhere in that ballpark?
2.6.
2.6. So do you think it'll end in the same according to theirs?
I have no idea. It's in their interest to understate it because things like Social Security are indexed to it.
Yeah. Yeah.
So understating inflation makes them tens of billions of dollars a year. How successful will they be maintaining the lie? For the last 45 years, they've been pretty successful. So,
yeah,
I mean, I'm not trying to be disrespectful, but I think that you're asking me to forecast a floating abstraction.
It's fair. No, it's fair. 1 to 10 probability we're heading into a recession the end of 2025.
I'm not an economist, and if you constrain me till the end of 2025, I would say 5 at worst.
Okay.
If you ask me if we're going to have a recession in the next 5 years, I think that's much more likely than not. But understand, I'm a credit analyst. I'm not an economist.
Understood. All right. Lastly, the recommended portfolio allocation has been 60-40, 60% stocks, 40% bonds for decades. And now that seems to be changing radically. Do you have an alternative recommended portfolio allocation involving, commodities, precious metals, the various classes that we've spoken about?
Not a satisfactory one for you. I would avoid rules of thumb like the plague. As an example, the 60-40 allocation doesn't take into account whether somebody is a postman or owns their own business with pricing power. Again, not being disrespectful, I don't like the question at all. I think that every individual circumstance, every individual's time preference and risk preference is different. And the consequence of that is that the 60-40 idea, while it is a wonderful way for stockbrokers to generate fees, has no other redeeming qualities.
It's a good answer. Rick, thank you for coming on to Metals and Miners. You've been so generous with your time, your analysis, and ideas. It's always wonderful to catch up with you. Would you share a key takeaway that you want viewers to keep in mind, and then let everybody know who's tuning in where they can learn about your work, how they can connect with you, and if you have anything else to add on the Rule Symposium?
Use common sense and invest in your own education. Education is the best investment you can make. It can't be taxed. It can't be stolen. It can, of course, be lost. If you're interested in natural resource education, go to the Rural Classroom. Primary reason is because it's absolutely free. There's hundreds of hours of instructional programming there, ruralclassroom.com. To put all of that in reference, go to ruralinvestmentmedia.com and list your natural resource stocks. I personally will rank them 1 to 10, understanding that the rankings are a snapshot in time. I'll comment on individual issues like I have on this show if I think that my comments might have value. Ruralинvestmentmedia.com, list your natural resource stocks. Please no crypto, please no tech stocks, please no pot stocks. Leave an old guy to do what he does well.
Outstanding. Anything else you want to add on the Rural Symposium?
I want people to come. I want people to come, and I want them to use the lessons there that they learn at the Rural Classroom. Get the big picture thinkers from the big picture thoughts from the people who speak from the belly of the beast. Listen to seasoned investors. Listen to the living legends. Pay particular attention to the exhibitors. That's where the money's made. Use the lessons that you learn at the Rural Classroom to improve your performance at the Natural Resources Investment Symposium.
Outstanding. I'll have links for everything: Rural Investment Media, Rural Classroom, Rural Symposium. They'll all be up there ready to click through. Everybody take advantage of all the free material. Take advantage of Rick and his ranking system, and take advantage of the Rural Symposium. I went last year. You will not be disappointed. It is amazing. It's a wonderful experience. And everyone's just so happy and joyful. It's a really great group of people to be around, not just the material. The people are spectacular, too. Rick, I look forward to having you back on sometime soon. Thanks for being here with us again. And everybody else, thanks for watching.
Pleasure, Gary. Thank you. And I look forward to hosting you in Boca.
See you then. Okay, so I want to welcome everybody to this fantastic interview with Rick Rule, founder of the Rural Symposium and Rural Investment Media. It's been a wonderful discussion so far. Before we wrap up and we have our final set of questions for Rick, I want to direct everyone interested in the metals and mining sector to dive into our Substack at metalsandminers.substack.com. Join our quickly growing community and receive a free report titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio.